The number is 500,000, not a million, not 10 million, just half a million. And most people think hitting that number means they've finally made it as investors. But something strange happens around this point. The exact habits that helped you build wealth from zero quietly start destroying your future wealth once your portfolio becomes large enough. Nobody notices it at first because nothing dramatic happens, no crash, no emergency, no red warning sign, your portfolio still goes up, you still feel responsible, still disciplined, still smart. But underneath the surface, tiny forms of friction begin eating away at compounding like rust under paint. And over the next 10 to 20 years, those small mistakes can cost you hundreds of thousands, sometimes millions, without you ever realizing where the money went. This is not a video about motivation. You already know you should invest consistently. You already know you should think long term. This is about something much more dangerous. This is about what changes once your money becomes big enough that the rules themselves change. Because building wealth and protecting wealth are two completely different games. And most people never realize when the game switched. The character in this story is Max. Max spent nearly 2 decades building his portfolio the smart way. Index funds, automatic investing, long-term thinking, no gambling, no meme stocks, no get-rich-quick nonsense. By age 44, Max crossed $500,000, and instead of feeling calm, he started feeling pressure to optimize. Pressure to become more sophisticated, pressure to manage his money better now that the number looked serious. That was the beginning of the problem, because once your portfolio becomes large enough, your job is no longer to accelerate. Your job is to reduce friction. Think of it like this. When you start investing with almost nothing, you're driving a speedboat. Fast, aggressive, constant movement. You need momentum because every dollar matters, but at around $500, you stop being a speedboat. You become a cargo ship, a massive machine carrying serious weight, and cargo ships don't win by making aggressive turns. They win by staying steady, minimizing drag, and avoiding unnecessary movement. Most investors never make this psychological transition. So today I want to show you the 3 things Max had to stop doing after crossing $500,000. Because these 3 habits are quietly destroying massive amounts of wealth for disciplined investors everywhere. And the scary part, almost all of them feel intelligent while doing it. This one hurts people's ego the most, because once investors build a sizable portfolio, they start believing they've earned the right to become more sophisticated. That's exactly what happened to Max. For years, he kept things simple. A few broad index funds, automatic monthly investing, minimal changes. It worked beautifully. But after crossing $500,000, something shifted psychologically. Suddenly, simplicity felt too basic. So Max opened a second brokerage account. At first, it looked harmless. A few stock picks, one actively managed ETF, a tech sector bet, some small cap exposure, then came dividend funds, then undervalued international opportunities, then AI stocks, then commodities, then REITs. Every decision sounded intelligent on its own. That's how the trap works. Individually reasonable decisions, collectively destructive behavior. And here's the brutal truth. Most professional fund managers fail to beat the market consistently. Not random amateurs, professionals, teams with analysts, research departments, expensive software, and Bloomberg terminals. Yet over long periods, most still underperform simple index funds. Now think about what that means for normal investors. Max wasn't competing against beginners. He was competing against people whose full-time career is investing. And the real problem wasn't even stock picking. The real problem was behavior. Because once Max started optimizing, he started watching his portfolio, constantly checking news, reacting to headlines, moving money around, second-guessing himself. Tiny emotional decisions started replacing disciplined automation. This is where investors lose unbelievable amounts of money, not from crashes, from behavior. Research has repeatedly shown that average investors underperform the very funds they invest in because of poor timing decisions. Buying after excitement, selling after fear, jumping in late, panic exiting early, missing recoveries at small portfolio sizes. This damage feels survivable. At $500,000, it becomes enormous. A tiny behavioral gap compounds into hundreds of thousands over time. That's the terrifying part about large portfolios. You no longer need catastrophic mistakes to lose massive money. Small friction becomes lethal. The speedboat mindset becomes dangerous inside a cargo ship portfolio. And this is the hardest lesson successful investors learn. Aggression helps you build wealth. retraint helps you keep it. This might be the most expensive invisible mistake in personal finance because the financial industry trained people to think in percentages instead of dollars. And percentages feel harmless. 1% sounds tiny, almost irrelevant. But compounding turns tiny percentages into financial monsters. After crossing $500,000, Max decided he finally needed professional management. It felt responsible, adult successful. So he hired an advisor charging a 1% assets under management fee. At first, the fee didn't feel painful because percentages hide reality, but then Max actually ran the math, and the math was horrifying. A 1% annual fee on a large growing portfolio doesn't just reduce returns slightly, it attacks compounding itself. Every year, money leaves the portfolio permanently, and the future growth of that money disappears too. That missing growth creates a chain reaction lasting decades. Imagine removing tiny pieces from a snowball while it rolls downhill. At first, the difference looks small, but by the bottom, the entire size changes. That's what fees do to compounding, the craziest part. The advisor's workload often barely changes while the fee scales massively upward. Managing a $3 million portfolio usually isn't 10 times harder than managing a $300,000 one. Yet the fee often becomes 10 times larger, and most investors never stop to question it because they're emotionally conditioned to associate higher wealth with needing more expensive management. The industry understands this psychology perfectly. Right, when investors hit larger milestones, they become most vulnerable to buying complexity. But here's the uncomfortable truth. Many wealthy investors are not losing the majority of their money to market crashes. They're losing it to constant friction, fees, taxes, emotional decisions, unnecessary movement, things that quietly drain performance every single year. Market crashes are obvious, fee drag is silent, and silent problems are often the most dangerous ones because investors don't feel the pain immediately. It arrives slowly, quickly, almost invisibly, until one day they realize their portfolio is dramatically smaller than it could have been. That realization hit Max hard. He wasn't paying for miracles. He was paying for activity. Meetings, reports, portfolio adjustments, constant movement disguised as sophistication, and the bigger the portfolio became, more expensive that movement got. That's when Max understood something important. Complexity is often sold as value because simplicity is difficult to monetize. This one surprises people because everyone hears the same advice: diversify, and diversification absolutely matters. But there's a point where diversification turns into confusion. That's what happened to Max. Originally, his portfolio was clean and simple: a total market fund, an international fund, a bond fund, easy, efficient. Then came optimization. A dividend ETF, a value ETF, a growth ETF, an AI ETF, emerging markets, real estate, commodities, gold sector funds, multiple S&P 500 funds from different brokerages. Eventually, Max had nearly 20 positions, and psychologically, it felt safe, sophisticated, protected. But when he finally looked closely, most of the funds owned the exact same companies: Apple, Microsoft, Nvidia, Amazon, over and over again in different packaging. He hadn't truly diversified. He had simply purchased the same businesses multiple times through different wrappers. This is where intelligent investors accidentally create chaos, not because they're reckless, because they're anxious. Once portfolios become large, fear changes shape. People stop fearing not having enough money. They start fearing losing what they built. And that fear creates complexity. Complexity feels productive, but often it's just emotional comfort disguised as strategy. The worst part? Over-diversification creates its own trap, because once large gains are spread across many positions, simplifying the portfolio becomes painful. Selling triggers taxes, rebalancing creates friction. Now the mess becomes permanent because cleaning it up is expensive. And that's how intelligent investors slowly become prisoners of their own portfolio structure. Max realized he spent more time managing overlap than improving results. More screens, more funds, more noise, but not better outcomes. It's like adding more instruments to an airplane cockpit until the pilot can't see through the windshield anymore. The tools become the obstacle. And ironically, many over-diversified portfolios eventually behave almost exactly like the market anyway, just with higher fees, more taxes, and more stress. That realization changed everything for Max, because he finally understood something most investors never do. The goal of a large portfolio is not complexity, it's efficiency. Here's the ironic part. The people most vulnerable to these mistakes are usually the most disciplined investors, not gamblers, not reckless traders, successful investors, because success creates confidence, and confidence makes people believe they should become more sophisticated over time. That's why so many investors sabotage themselves right after reaching major milestones. They stop trusting the boring strategy that made them wealthy in the first place. And the financial industry encourages this transition constantly. Private investments, structured products, alternative assets, exclusive opportunities. Institutional strategies, everything is marketed as the next level, but often the sophistication itself becomes the drag. More complexity usually means higher fees, higher taxes, more emotional decisions, more friction. And friction is the enemy of compounding. The wealthy investor who keeps things simple often outperforms the wealthy investor constantly trying to optimize. That feels counterintuitive, but history keeps proving it. Once Max realized this, he made three major changes. First, he stopped trying to outperform the market. No more constant portfolio adjustments, no more chasing trends, no more emotional reactions to headlines. He focused on participation instead of prediction. Second, he audited every fee in dollar terms, not percentages, actual dollars. That changed everything psychologically because seeing real annual costs forces honesty. Third, he simplified aggressively. He removed overlapping positions, reduced unnecessary funds, focused on clarity instead of complexity. And something strange happened after simplifying. His stress dropped, his decision-making improved, and most importantly, his portfolio became easier to leave alone. That matters more than most people realize because large fortunes are often destroyed by excessive interference, not lack of intelligence. The cargo ship wins by staying steady, not by constantly changing direction. If you remember nothing else from this video, remember this. The strategy required to build your first $500,000 is not always the same strategy required to protect and compound the next several million. At small portfolio sizes, action creates opportunity. At large portfolio sizes, unnecessary action creates drag. That's the shift. That's the entire game. And most people never realize when the game changed. Max eventually understood that wealth is not built through endless optimization. It's built through minimizing friction long enough for compounding to do the heavy lifting. That sounds boring, but boring compounds. Excitement usually doesn't. The investor constantly chasing better strategies often loses to the investor quietly staying consistent for decades. Not because they're smarter, because they interfere less. The cargo ship, loaded correctly, moving steadily through the ocean with minimal resistance, almost always reaches its destination faster than the speedboat, constantly trying to outmaneuver the waves. And once your portfolio crosses $500, that difference becomes life-changing.